Steve, we appreciate your time. You're not going to be able to see all of our guests, but I think we've invited about 75 people to join our webinar here. And again, thanks so much for taking this time. It's kind of our inaugural series on the CFO position, kind of a CFO story. And it's my pleasure to kind of introduce you to our audience here. Steve Louden, one of my favorite CFOs, who was placement of mine early in my search career, and it's been great to kind of watch you flourish as a CFO, being CFO of Roku from 2015 through 2023, during a time when the company went public at I think a market cap of 1.7 billion, and then reached a pandemic peak of 50 billion, quite a feat. And so, what I think what we want to do today is just have a conversation around your IPO process, in particular, kind of the story you had with Roku, and from that, kind of extract some pragmatic lessons for the audience of CFOs and board members. I'm going to pull up just a brief agenda and establish some rules of the road. Just give me 1 second here, and I'll do a share screen.
So while you're doing that, thanks to you and Kingsley Gate for having me. As you mentioned, you and I go way back, and you've been a good, not only a good recruiter source for me, but also a good sounding board for pressure testing different things throughout my career, both personally and for Roku. So I appreciate it.
Sure. And while I look for the files, why don't you just give a little bit of your professional background and also what you're up to today?
Yeah, sure. And thanks everybody for joining. Yeah, so the quick summary for me is, I've had a career in various financial roles, strategy roles. As you mentioned, I was a CFO for Roku for quite a while. Prior to that, I was the treasurer and head of corporate finance before that at Expedia. I also worked at Washington Mutual on the retail bank side. Unfortunately, I was there when the place blew up. And prior to that, I was a McKinsey consultant after business school. And then prior to business school, I was at Disney in strategic planning and finance roles. And then I actually started my career at Merrill Lynch as an investment banking analyst. So different industries, different types of roles, but what really pieces it together is I've focused on solving complex, ambiguous business problems. That's kind of what I like to do at a high level. And then since semi-retiring from Roku last year, after I found a replacement, I'm on a couple public company boards, Zoomies Inc. and SunPower as the audit committee chair, and also the lead independent director at SunPower. So I'm focusing on my time on boards these days and some other advisory and investing work.
Wonderful. And it's a good segue to our agenda. Hopefully can everyone see the document that I pulled up? Today's agenda.
I can see it at least, yeah.
Okay, great. And so what we'll do here is we've got between 45 minutes and an hour. I'll set the stage a little bit in terms of some interesting IPO insights that I gleaned from an Ernst & Young IPO report that I think was quite interesting and relevant. And then Steve will kind of banter about, and I'll ask you all about your career, and you'll share some insights. For those of you in cyberspace, you should have a Q&A button, and so feel free to log in those questions. That'll come to me, and depending on the number of questions, I may kind of direct them to Steve during our conversation, or depending on the magnitude, we may kind of hold them back till the very end. So with all that, I want to just pull up a sheet here that I found really interesting, and to some extent this may be all intuitive to everyone, but clearly the demand by private company CEOs and management teams to go public as some form of liquidity or exit option is strong. I mean, it's still there. And there's probably a healthy pipeline of management teams that want to do that. It's interesting when you look at 2023, which I think we would all appreciate as a challenging year in some ways, although the stock market did well on an indice basis, US IPOs actually lagged the index, which I thought was interesting. And maybe even more interesting was it was reversed once you looked outside of the US. You saw outperformance in Asia and Europe relative to the indices. The other thought that kind of came to my mind as I read the report was a little bit of back to, let's call it old school investment banking capital markets, where the smaller IPOs outperformed the larger ones, again, based on this cross section of data from E&Y. When I've talked to PE sponsors in the last 5 years, I think there was this option value for companies to stay private, given the financing markets. And perhaps what we'll see now in the next 12 to 18 months is actually smaller companies go out as public companies. I guess before I jump in, Steve, I'd love to kind of maybe get your quick reactions to the E&Y insights here.
Yeah, like you said, I think perhaps a good chunk of that, at least in the US, had to do with the private markets being very robust. You had a lot of traditional players that would focus on the public market that were getting deep into the private market. You know, at Roku, as an example, Fidelity invested in us as a private company, and that was probably on the earlier stage of that. You know, public investors getting sort of earlier on into certain companies. And then you had just a lot of money that flowed into VC funds and PE funds. So I think there was a lot of reasons and a lot of generous term sheets during that time, which kept a lot of companies private longer, which may be shaking out over the last year or two. And I think that's a big part of it. So for those big investors, it was a way to capture more of the upside, especially of some of the higher profile, bigger names, which may explain, why some of the maybe smaller IPOs that are less looked at as the sort of hot places to put a lot of money into as a private company. So it'll be interesting to see if that normalizes or if this is just a blip and it'll go back to the sort of heady days of a lot of private money chasing good deals.
Right. I want to go back to kind of the 2015, 2017 time period when you were a CFO of Roku and you took them through an IPO. Why did you guys go public? And what should our audience think about as far as the pros and cons of an IPO?
Yeah, so I think there's simplistically a couple reasons to do an IPO. One is you need the money,
Sure.
and the private, and you think it's a more attractive space to get money than the private market. And then secondarily is the liquidity for the existing shareholders piece. Roku, in its history, especially early days, and when I joined in 2015, it was not considered a hot company per se. Our founder and CEO, Anthony Wood, just a tech genius, great track record. He's the guy who invented the DVR back in the day. Roku is one of multiple companies he started and successfully sold or taken public in this case. But the simple fact was when I joined, it was 90+% hardware revenue. A lot of the private investors, especially the Silicon Valley VCs, didn't love hardware businesses and had gotten previously burned, in recent times at that point with things like GoPro and Fitbit that were largely hardware and sold a different story. GoPro sold their media company. Fitbit was talking about how they're a lifestyle, kind of data company. And those IPOs had started strong and then were way off the mark. And so that was a difficult environment. And so when we were raising the private round, when I first got there, it was extremely difficult. I talked to 100 plus people, got tons of rejections, and it was difficult to scrape a round together. And then also for Roku in particular, not only was the hardware an issue, but we were simultaneously trying to take on Amazon, Apple, and Google, and any one of those can crush startups in a vertical. So taking 3 of them on simultaneously was not thought to be a winning proposition. So that was pretty difficult. And so we raised a private round when I got there. I come from a public company background, from Expedia and WAMU and then Disney earlier in my career. And so one of the other big things we had to assess in terms of going public, both to get incremental capital because we were still running some losses at that time, but also liquidity, was our readiness to go as a company. And we could talk, we can talk more about that, but that's, certainly getting the capital is important, but also making sure you're ready to get IPO and that you'll be an attractive IPO prospect, not only because of the market, because of the performance trends you're putting on, but then also your ability to manage the business once it goes public.
And Steve, I want to build on that point, which is, you had been at larger public companies. You probably had a sense of what's required not only to list, but to operate effectively as a public company. Kind of take us back to how you assess the capabilities of the CFO organization and the broader executive team, and how you kind of added muscle, so to speak, and built capability.
Yeah, sure. And that's, that's really important for folks. I was lucky enough, especially at Expedia, to be part of the team that was a key member of the quarterly earnings cycle. And I did a bit of that at other places as well. So I just knew how rigorous the process was, both in terms of being, tight on your close process. How do you translate the story, the metrics and the performance into the story, and then actually, becoming a credible source of information for the street as part of the management team. So that's really important. So when I got to Roku, as an example, I had joined, they hadn't had a CFO in over 6 months. They had a small finance team. They had lost their head of FP&A as well. And so myself and the new head of FP&A, really had to work to kind of revitalize the organization. That the company didn't have a lot of people that had been in public companies. Anthony's a serial entrepreneur, and so a lot of the exec team, had been in multiple private companies, but not in public companies. So we really had to start establishing the internal cadence and, kind of the level of accuracy and discipline that you needed to act like a public company. And so that was really important. So we actually instituted public company calendars in terms of, okay, we need to have our close process done by day X. We're going to literally write a shareholder letter. We're going to have a mock earnings call, and we're going to kind of keep repeating. And when we first started, it did not go well, as you would expect. But by that discipline, we were able to kind of get better and better over time. At the same part, there was, I thankfully knew a bunch of analysts from my Expedia days when I was treasurer. And so a lot of them had overlapping coverage universes for where Roku might fit if we went public. So I got some honest feedback from them about how Roku was perceived and what we would need to do. And one of the biggest things was, start to shift the revenue mix from, almost exclusively hardware to a mix of hardware and software or let's call it non-hardware, because it included advertising revenue. It included streaming rev share revenues. And so we had to diversify the mix because not only did the private investors not love hardware companies, nor did public investors. So that took us a couple of years to basically get that discipline, show enough progress on the transition in the mix of revenue to non-hardware revenue to really set ourselves up for success for the IPO.
And just to build on that point around this is a complex business, and there's a storytelling aspect. Let's shift a little bit to I know Steve, you and I have talked about this, which is managing your advisors, your bankers, your lawyers, and accountants during the IPO. And so I want to both hear from you around that experience, and then a little bit of the 7 years later, you've picked up so much wisdom over the years, like for the audience members here who may be contemplating an IPO in the next 12 to 18 months, like what should they take away from any lessons you've learned?
Yeah, no, there's a lot of lessons, and like most good lessons, they're learned with some pain involved potentially.
Yeah.
I think the biggest thing for companies is to have a strong sense on what you think the story is and what are the credible pieces of evidence behind that. The management side of this and the conviction of the management and credibility is of utmost importance. And so you're going to get in the IPO, you're going to get a lot of advice from a lot of different sources. It's not always consistent. And frankly, one of the difficult processes one of the difficult parts of the IPO process is, putting together the right set of advisors. And, the banking group is probably the most fraught. The banks will pitch you for the IPO, and companies will hold bake-offs or, develop longer-term relationships with certain banks. But just remember that every advisor has their own lens to see the company in, and also their own motivations, right? And so, we've at Roku, when we're putting together the bank group, there was a lot of squabbling between the banks, as you would imagine, not only for the roles, but also their share of the fees. And in some cases, that didn't work in the company's best interest. So there was, without naming names, there was a certain bank that we had originally offered a lead book runner position, but they were so focused on trying to benchmark their fees against other banks that it didn't leave enough of the rest of the pot to fill out the non-active banks in the mix, and thus we would have had to go out with a less broad coverage universe. And so we ended up kind of kicking them out of the deal before we got too far in the process, because we couldn't align on fees, and we didn't think that was justified. The other part is just knowing that at the end of the day, the company is going to have to make the decision on things like pricing. I think a lot of companies just default to say, hey, the bankers are the experts, or the other advisors are the experts. But when you're talking in an IPO process about pricing in particular, then if it's down to the, whether you price a share $1 or $2 more or less, just remember that the banks that are talking to you, they deal with the public investors every day or every week. They deal with you once a year if you're lucky on capital markets transactions. So you got to ask yourself, where would they rather have the extra buck go to?
Right.
So there's a lot of great advice. I gave you a couple sort of war stories on the things to be careful with. There's some great bankers that I still have significant relationships that I've brought to different places because I do trust them, and they've got great expertise. But you also have to have a kind of an independent view and say, hey, does this make sense for what I think's in my best interest for the company? And sometimes you have to have a hard conversation or have a hard call.
And Steve, I think I looked at the price performance of the IPO. I think it was up maybe 15 or 20%, which is kind of what you want ideally as a company, not leaving too much in terms of proceeds, but at the same time, kind of covering the IPO discount. So well done on that. And I also think that Roku's have been very clean in terms of the accounting and the processes. You as a CFO who didn't come up the accounting route, like how did you strengthen and make sure that the accounting and controls function was public company ready?
Yeah, it's a good point. So yeah, I'm not a CPA by trade. I've certainly spent a lot of time on the accounting side over the career and years. But I think one of the most important things is to, when you're a private company, to really start to have that discipline of the close process and the audit. And frankly, I've been fortunate that I've spent a lot of time trying to hire and motivate and give a lot of opportunities to really good people, and then let them do their thing and provide air cover and problem solving support. And so, I think a lot of this stuff comes to setting up the discipline early and making your mistakes before you get to prime time. And then also letting good people do their thing. So I was fortunate at Roku to have two great controllers, and the guy I hired 3 or 4 years ago, Matt Banks, now the chief accounting officer. Like, he's a great example of someone who, you give that person the space. He came from Facebook, and then also had some private company experience. So, he's a great example of hire somebody great with a lot of potential and relevant background, and then support him as needed.
And hiring isn't complete without retention. And I'm mindful of, I think Anthony had a pretty strong view around compensation and how you attract talent. Maybe talk about, that transition as you brought in more people from public company environments, to join Roku. Like, how did you work with HR and other folks to revise the compensation program and to maximize retention of the company?
Yeah, that's a good one. And certainly Anthony, like Reed Hastings over at Netflix, they're, those guys are, friends. And also Anthony worked for Reed for a brief period, in the early days. But I think, Anthony's philosophy was that, he wanted to pay, like Netflix, he wanted to pay for performance, and he wanted to make sure that people had some control over more control than on average that the companies give them. And so we had a focus on total compensation. So not, we would literally give somebody a number that said, here's your total compensation, and it's a mix of cash and equity. But we thought about it that way. And for a long period of time, we actually gave people the ability to, determine within, pretty broad bounds what percentage of that would be cash versus equity, right? And so we really did think of like, hey, the total amount you're going to make, the target is this. For a while, we also had kind of a minimum guarantee. So that said, hey, if you didn't get if something happened with, say, the stock price or the performance of the company, and you didn't get your total comp, then we would actually top that up. We also tended to have a high base salary piece and long-term incentive in the form of equity. Early days, it was all options, and then it became more of a mix as we became a public company, and we were bringing people more from the public company realm, so they were more used to restricted stock versus taking the risk profile of the options. But we gave some flexibility for the execs on whether you took restricted stock or options. But one of the other interesting things was we didn't have a annual performance bonus that was kind of pegged into your salary. And Anthony had a culture that was very explicit that we're not a lot of Silicon Valley firms tend to say we're your family, which obviously the last year has proved that they're not your family because they're having layoffs and stuff. But we were very explicit that we operate more like at Roku, like a professional sports team. And so we've effectively guaranteed your performance bonus, because if you don't perform, we let you go. And we had a generous severance policy to really incent managers to say, hey, if you don't have a high performer in this role, the best thing you can do is performance manage them out and find somebody who can perform at the level we need, and give them a good severance, and they would have cushion to go find a job that's a better fit. And so that culture and that comp philosophy, served the company very well. And there were tweaks we made to it over time, because as you get public, as you get bigger, Certainly as you go into other countries, you're pulling from a different risk profile of candidates. And as a result, you need to kind of temper that.
Yeah, I'm mindful of all that unique comp philosophy. It is certainly a differentiator, and I think the performance of the company kind of validates it. Um, let's talk about the last few years as a public company. I mean, obviously with Roku, like many companies, they had kind of this pandemic spike, and then kind of a restructuring period, and you've kind of seen the highs and lows, so to speak. What should our audience take away in terms of being the CFO during periods of volatility? I'm talking about, handling the ups and downs, the emotional stress. I'm talking about retention, as well as making the tough decisions on costs. Like what kind of comes to mind for you, Steve?
Yeah, I think, well, taking a few steps back, I mean, we talked about the IPO process, and I think a
Yeah.
lot of companies that's a massive milestone. It's a huge goal, and it takes a lot of work to get there, and then hopefully accomplish a successful IPO. But really, that's just the start of the new race, right? And so you then have to manage the company after that. So
Right.
part of the method to the madness is not only getting the IPO out the door, but like I said, creating that discipline ahead of time to manage the company going forward, right? And that first year as a public company is absolutely critical that you do what you say you're going to do, right? The company's out of the gate. A lot of investors are wary or skeptical because you don't have a track record, and so being able to manage that and being very transparent about here's what went well, here's what didn't go well, and here's what we're working on, right? To get to the next set of goals. A lot of companies, I think, try to, put spin on things, but the key is to set measurable goals, get over them, and that's really important. So I think that's a piece that you need to do. But in terms of managing the ups and
Steve, just
downs,
just a follow-up on that point. I'm glad you brought me back to kind of the first couple of years after the IPO. So you had talked about how you're building the advertising business on top of the core hardware business. How did you meet your numbers? In other words, how did you kind of meet or exceed your forecast? Was there some discipline that you incorporated within the planning process, for example?
yeah, certainly. So yeah, the Roku was a really difficult business to manage because, like you said, you've got the core hardware business. Over time, it became even more complex. We originally just sold the streaming boxes and the streaming sticks. Then we got into licensing our operating system for TV manufacturers. Before I left, we were actually manufacturing our own TVs. And then you got into the advertising business. You had the streaming revenue shares for the SVOD services. So there were a lot of different businesses within Roku to try to forecast. So obviously having some cushion in there is always a good thing without sandbagging too much. And just being realistic about as we got into businesses, how long things would take to ramp up, what were some of the critical factors in terms of understanding whether the business was working or not, and trying to make hard calls on if things weren't working, to cut it off and move on to the next thing. Roku had a lot of things it could work on, had a lot of potential growth factors. So not getting too enamored by the shiny new object and saying, hey, this isn't working, so we either need to retool it or that, and reflecting that in our forecast. So we didn't always get it right, but especially when we were public, for the most part, we had a pretty high percentage track record.
Got it. And I think you were just about to talk about kind of managing volatility and keeping
Yeah.
it.
Yeah. So one of the most important parts of managing volatility is managing the perception of volatility internally, especially around the stock price when a good chunk of compensation is related to stock. I think one of the best things I did was when we first went public and the stock price was going up and up and up. And then certainly when the pandemic hit, it accelerated even more. every time we had our earnings and our, most times the stock popped up quite a bit. The next morning on our all hands, what we call our coffee talk, at some point I would say, hey, and remember, you're not 20% more awesome today than you were yesterday, just as you wouldn't be 20% less awesome if the stock had gone down. Now, thankfully for Roku, the stock had gone up a lot and over a lot of quarters. But when the stock started going down because of recessionary fears, that really impacted the ad market. We had both a initial pandemic ad drop off, and then about a year and a half ago, we had just an absolute implosion of the ad scatter market, where within a month, our ad revenues, which is the single biggest revenue stream at Roku, went down about 60-70%. And so that's a lot of volatility. But one of the first things is just to manage the perception of like, hey, the stock market is not the performance. We probably got too much credit in the pandemic, and we probably got slammed too hard initially when the ad market went down, because we thought that was a cyclical thing, not a structural thing for Roku. And then to really, both internally and externally talked about, hey, here's what's happening right now, is in understanding how much of this is a macro thing, how much of this is an industry thing, and how much of this is a company thing, right? Yeah. And so to work on what can we control on the company. In that case, if your revenue is going way down, then you have to take a hard look at costs. And if you were investing for future growth, you may not be able to afford that, right? And we had to make some hard decisions about layoffs and shelving projects and all that, which a lot of companies have been doing over the last year and a half. But then we also need to tell the story that, hey, this is a cyclical headwind, and we still think there's a large long-term opportunity here, and have some credibility around, why we believe that there's a difference, right? And I think the street tends to, take a sell first, ask questions later type mentality when things get bad. And so that was important over 3 or 4 quarters, but it took that long to stabilize some of the fears and say, okay, in the meantime, here's what we're going to do, that we can control the OpEx. We're going to work on these other things. We're going to continue to grab market share in a down market, and we're not going to completely turn off the investment lens for things that we believe in, but we'll be a lot more selective. And then reestablishing a track record in the new environment, say, okay, these guys said this last quarter, they've actually gone and done that, right? They've taken some cost out. They've launched this, new TV product. It's working, and you got to just kind of restart, right? And then obviously knowing that the investors have a different lens, right? It went from, for a lot of years, growth at almost all costs. So, as long as you can manage the cash flows with your cash and liquidity or incremental fundraising, then, running a negative cash flow or negative EBITDA was not as big of a deal as showing top line growth, showing gross profit growth. But it flipped very quickly, right? And so one of the things we did was talk about what we're going to do in the short term, and then we reestablished very quickly, hey, we're EBITDA negative at Roku this year, but by 2024 we'll be back. And the companies, made progress on that when I was there, and then our new CFOs continue to make good progress, and they've reaffirmed that commitment, which has gone a long way.
Yeah, and I'm mindful that there might have been some migration in the investor base, whether it's Kathy Wood,
absolutely, yeah,
kind of getting in the stock. When sometimes people say, hey, I need a great VP of investor relations because I need to really manage the story. Like, what's your take on, like, what are the 2 or 3 things that constitute an effective IR strategy? Like, and let's get granular, because I get this question a lot from clients.
Yeah, I think it's interesting. The IR role at various companies, I think, is one of the most unique roles, because it could be played so many different ways. Certain companies, the IR role is primarily a comms role, communication role. Some of the best IR folks that I've seen, are CFOs in their own right. Like they're highly analytical, they're taking an inside view, they're, dissecting the forecast, the product plans, like a CFO or even like a CEO would. And then they're sort of looking at it from both lenses. They're having, persuasive conversations with the analyst community because they really understand the business versus just kind of putting some spin on things. And so I've been lucky. The IR head that's still at Roku, Conrad Grad, who's II ranked #1 in the industry. He's a great example of somebody. He knew the business as well as I did. I mean, and could have very credible conversations. He would run his own analyst model, trying to look outside in at what people could do. He was understanding the analyst models, and that I think is really important. So I like that more analytical view, but he was also an amazing communicator with the broader investor community. He had good relationships around. So I think there's some companies that I think don't put a lot of stock into IR, and it's a bit of an afterthought, and it maybe is staffed with people that are primarily communications or thought of as a PR for investors. But I think there's, really good IR. You have people that are very analytical, and are deep in the business. And I think that can, my personal opinion, but I think that can pay big dividends.
Perfect. If you have any questions around kind of the IPO or kind of public company part of our conversations, just hit a chat and do that, and we'll kind of monitor that. For the last, say, 5 or 10 minutes, I want to shift the conversation a little bit to what you're doing today, Steve, which is serving as a professional board member on 2 public companies. And maybe I'll just kick it off in terms of, we certainly have seen tremendous and increasing demand for CFOs to be public company board members. What role do you play as a former CFO on these 2 boards? Like, what are the topics that tend to kind of migrate towards you, where you're the expert?
Yeah, so certainly public companies need a financial expert, and so CFO is one of those buckets of folks that have demonstrated financial expertise, I guess, for lack of a better term, that would qualify for that financial expert status. So we're financial experts. We're a necessary evil on a public company board. You generally are, you certainly will be on the audit committee. You almost certainly will be teed up for an audit committee chair, if not, initially, then at some point. My first board, Zoomies, I was brought in because they knew that the long-term audit committee chair was going to retire from the board, and so they did a great job of kind of bringing somebody like me on, having enough transition time with the outgoing audit committee chair to learn the business and learn from him, and then take that over. And so I think the board will necessarily look at you for a range of financial activities. One of the things, I think it's definitely a backhanded compliment, but I think one of the interesting piece of feedback I got from my boards was, after I came in and after a few meetings, people said, like, hey, this is great. You're actually contributing to some of the business conversations that we're having. So the idea was that, hey, you're a financial expert. We brought you in to be the finance geek. But more broadly, you have a perspective on the business. And I think, that's some for people to think about is, boards may initially hire an ex-CFO or an ex-audit partner for the financial expert designation, and they may think of you very narrowly. But I think one of them will, CFOs especially are highly analytical. You're a CFO not because you're necessarily a uber controller, and I don't have the CPA background, but you spend more time than just the core accounting work, analyzing the business, looking at capital allocation, looking at the strategy against the competitors, looking at the macro environment, all these things. And I think that's one of the pieces where if you're sort of a good CFO and strategic minded, you can be a strategic minded board member while also being the financial expert that the board maybe initially hired you for. And I think that's really critical to bring those two pieces together to add the most value for a board.
Yeah, absolutely. And since it's 2024 and the world is awash with talk about AI, I'm curious if you're starting to see, maybe even in its very early infancy, AI starting to impact the CFO organization, i.e., what are CFO orgs doing to incorporate AI into their day-to-day activities?
Yeah, it's a really interesting question. Roku, just given it's a tech firm and Anthony's such an innovator with technology, we spent a lot of time on it broadly. And within the finance org, I think what's been interesting to me, maybe I'll take it out a bit and then
Sure.
talk about some of the things I'm thinking personally about. First of all, what's interesting to me is that there's it's such a new thing and it has such a great amount of promise and hype to it that there's such a wide range of reactions to it. Some people are trying to experiment with a little bit. I think in general, finance people are pretty cautious, rightly so, because you don't want to throw AI in a process and have a SOX issue related to it. AI is an amazing tool, but it can spit out gibberish, right? And so you really need to have the right processes and control around it. So we've talked about, and I talked to the companies I'm on board about is, okay, how do we leverage this to I don't think AI is going to replace everybody in the next couple of years, but people and companies that know how to leverage AI will become way more efficient and they can save money and save time. But you need to do that in a way that you have the right controls, because obviously on the financial side of things, you get things wrong, very bad things can happen. And so I think that's the piece of it. But I think, if you look at it the lens of how does this empower our folks and make them more productive, I think that's the right way to do it. But the making sure you've got the right controls around it is critical.
Yep, wonderful. Why don't we open it up to any Q&A, and again, send any questions to the Q&A button and they'll route to me. Our first question is, and I think you talked a little bit about this, Steve, and your humility kind of came out when you talked about some of the mistakes that you make along the way. Like, any ones come to mind that were really pivotal in terms of your development as a CFO and now a board member?
Well, maybe I'll point to one early one and then talk about how as a CFO, I'm still learning that lesson. So I talk about hiring great people. Well, one of the painful lessons I learned when I was first became a manager, I was at Disney at the time, and I hired my first analyst, and the guy was super smart. And after a couple months, we weren't getting the productivity advantages that I was expecting. And when I kind of sat down and talked to him, he gave me some honest feedback, which is sometimes tough to get as a manager. But it turned out he was not the problem, I was the problem. And so I just was assuming as a manager that people always thought like me, and that they could do everything I could do, kind of when I was in their shoes. And it was a good lesson because he was a great, capable guy. I was managing him very poorly. I thought I gave him enough context, but I wasn't. I thought, I was giving enough support when he got stuck, but I wasn't. And I wasn't cluing into a lot of the signals that he was kind of sending back. And that was a great lesson, because I realized, if you have a problem as a manager or a director of a group or a leader, or an exec or whatever, almost always the problem is you. And it definitely is at some level. Now you could have people that aren't working out, and you can have a objective conversation about why they're not working out and do we need to exit them from the organization. But for the most part, it's the people side of things is, I think, especially for finance people and CFOs in the mix there, the people side doesn't get the amount of attention that it probably deserves. Because I would say for me, I've always been a very logic-oriented, objective person. I think a lot of finance people are naturally that way. Otherwise, you wouldn't get into finance and your love of numbers. But the people side is, maybe more challenging, but has more upside than just being really smart and a good problem solver. And for me, that's been more and more apparent, because as you move up the chain, especially as a CFO, having the right answer is necessary, but not sufficient to get stuff done. You need to pull a lot of various people together, and some of them don't, historically don't like finance. They don't, this is stereotypical, so I'll flag that ahead of time. If you're talking the head of sales and all you talk to them is numbers and how they're not performing or whatever, you're missing the boat, because the salespeople are relationship people. Salespeople think about promise and growth and opportunity, right? And want to give their people the benefit of the doubt. And so you need to understand how to flex to people's styles, both within your org, so people who work for you, but also across the org. And then as a CFO, externally focused, especially as a public company, other stakeholders. And so you need to be able to, work with the people side of things. And I think for a lot of CFOs, being a really good CFO, that's a differentiator, is actually the people side, not necessarily the number side.
Steve, and a great point. In fact, I have a follow-up question on that. So how do you balance being directive and supportive to partners in the business?
Well, I think a lot of it comes down to building up prior credibility and relationships. And then, so let me put that over to the side. I'll talk the other half of it. And this is a corny acronym for a really important topic that I coined. I created this thing called being bird-like, BIRD. And I talked to the finance people, and this goes from the CFO all the way down to analysts or whoever, accountants and whatever in the rank and file. And I said, most business partners view finance as a bureaucratic morass that's just designed to tell them that they can't do the stuff that they want to do or they think they need to do to move the business forward. And so the way we stop being people that are clutching the budget and telling them no is we need to think about our relationship with the business partners or other functional stakeholder groups as we provide business insight that's relevant and digestible, right? That's the BIRD. Yep. We don't provide data. We don't provide reports. We provide business insight. So we're often closer to the data than our business partners are sometimes. And so we should be looking, and we're numbers oriented, we're analytically oriented. So we should be looking at that, understanding trends, understanding risks and opportunities. And so we should be creating some business insight from our numbers and our deliverables, right? And that could go for the close process, that could go to the forecast or actuals, et cetera. So that's the business insight. The relevant piece is we've developed a relationship with our key business partners. We understand their priorities because we've asked them about it. We help them try to figure out how to actually achieve those priorities. And so we can tailor that business insight to what we know is relevant for their priorities. And then my pet peeve, even though I've given you a ton of long-winded answers today, is digestibility. So finance people and a lot of, logic-oriented people, they like to build from the bottom up. Like, hey, let me tell you about A, let me tell you about B, C, D in detail, and then I'll eventually get to the key finding. Especially execs, they need to know, here's what's really important about this report or this trend or the performance last month. And if they care or they disagree, then they'll say, okay, well, actually, give me the next level down. What are your 3 key points of why you said that, right? And here's the facts behind that, right? Or here's my logic change. So flipping that, sometimes that's called the pyramid principle, where you start at the top, sort of work your way back down to the support. That's really important. So that's business insight that's relevant and digestible. So you need to have that mentality, in my opinion. And that's frankly hard, especially when you hire finance people from different orgs where they are bureaucratic gatekeepers, that getting that mentality of like, no, like the business doesn't work for us, we work for the business, right? In finance. And then the key is doing all that work about providing business insight, understanding the priorities, making that relevancy, and giving them keen insights, and then helping them solve their problems. You need to do that ahead of time. So when stuff hits the fan and you have a hard conversation to have, they know that you actually have their best interests in mind. They may not always agree with you, but that is the key, because if you're the first time you tell somebody, hey, you guys, your team or this part of this division of the business is not performing, or hey, we're going to have to cut costs because the company's, struggling, like that will be a very adversarial conversation if you haven't built up a ton of credibility ahead of time.
It's a great answer. I love the you got to put a trademark or a copyright on Bert. That's I've taken copious notes on that one. Last question from the group, which is, some companies are thinking about doing IPOs on exchanges outside of the U.S., so not necessarily NASDAQ or the New York Stock Exchange. Do you have a view around either dual listing or listing in some of the smaller markets outside of the U.S.?
Yeah, I think it gets back to what's the objective of the company. I mean, certainly if there's a company has key operations in key markets elsewhere, that might be helpful. If you're looking for money and you're looking for liquidity, that it's still hard to replicate the U.S. markets. And so I think dual listings could make sense in certain cases, but I'd be wary to think of a company that says, hey, I don't need the U.S. And so I'm just going to list somewhere else. Because you're just adding, you have lower investment pools that you can access. You have just as much brain damage on a quarterly basis, if not more. And then, you're also, some of those other exchanges have, a history of having weird rule changes, or they're boom and bust in that market. And it's not that the U.S. isn't boom and bust as well, but there's a lot of liquidity in that market and a lot of interest. And so it'd be hard pressed for me to think, except in niche cases, that's a winning strategy for folks.
Got it. Well, Steve, I think we're at our end here. First of all, thank you so much. What a enlightening, fascinating conversation. I think very timely given 2024 and hopefully the opening of the IPO markets. And more importantly, I think it's about running a business in a sustainable fashion as a public company CFO, and you've brought tremendous insight to that. So thank you and much appreciated.
Yeah, thanks, Ed. Thanks for having me, and thanks for others listening. Hope you glean some good nuggets from my painful journey at points. But yeah, good luck to everybody.
All right. Bye now.
Cheers.